This is Wealth BT, a podcast of BT correspondents.
Investing in the U.S. has been very rewarding for decades. Whether you're invested in an S&P 500 ETF or have focused bets on technology. In fact, the U.S. is so central to financial markets that most private wealth portfolios are in U.S. dollars. Until recently, that's mostly unquestioned. But last year, something changed. Liberation Day in April ushered in wide-reaching tariffs, which raised major questions about deglobalization and the realignment of trade and superpowers. On top of that, are challenges to the US dollar as a safe haven asset. Is the dollar debasement trend here for the long term? Is the concept of US exceptionalism dead, as some have proclaimed? Last year, the S&P 500 underperformed the rest of the world, including Asia and the emerging markets. The US dollar index, which is the dollar against a basket of currencies, fell more than 9% in 2025, and this year has softened further. If US exceptionalism is fading, what are the implications for investors who are mostly overweight the US because of big tech and AI? Welcome to Wealth BT. I'm your host, Genevieve Cua, Wealth Editor of the Business Times. My guest is Andy Budden, Investment Director at the Capital Group. Andy has more than 3 decades of experience in financial markets. Thank you for joining us, Andy.
Hi, Jen, and thanks for the opportunity to be here.
Let's start with a report you published at the end of 2024, which was very optimistic about the U.S. as a destination for capital. How do you define U.S. exceptionalism, and what has changed since then?
American exceptionalism, it's become a very popular term over the last 5 years or so, and that's happened for good and for bad reasons. The good is really what's happened since the global financial crisis, which is a really strong economic recovery, and then also very, very strong US equity returns as well. The bad is what's happened a little bit more recently. So it's the unconventional and sometimes quite disruptive actions of the US administration. And then it's the fact that US equities underperformed the rest of the world last year. So 2025 for the first time in quite a long while. So the work that we did actually a year ago now really aimed to disentangle what exactly is going on with American exceptionalism. And we started this by defining what it is. And we really came up with 2 foundations. So the first foundation is a formula for enduring economic growth. It's not always the fastest growing economy, and the US most definitely does have economic cycles, although I'd also argue that the US economy has a very good track record of very quickly repairing itself from recessions. But it's a record of just being persistently strong. And this is really based on the US's very special role as the global hub of innovation, which drives productivity growth, and then that drives economic growth. So that's foundation number 1. Foundation number 2 is the US is a great place to be an investor. Company managements are strongly focused on generating shareholder value, in part because actually they themselves are very large shareholders through stock options. And they're operating in an environment with deep and dynamic capital markets, pretty strong rules and regulations that are generally quite pro-growth and generally quite reliable. And we've all seen just how rewarding that formula can be. So very strong returns since the global financial crisis. Actually, if you extend the time horizon a little bit, say over the last 40 years, which is when MSCI first created the non-US index, the US has outperformed the rest of the world's 2/3 of the time over the last 40 years. But actually, it's even more enduring than that. The statistic that really surprises me every time I think about it is that since 1900, the US has outperformed the rest of the world by 2.5% per annum. So it's a remarkable record of outperformance. And I think we need to be really quite careful, actually, Jen, before we rush to conclude that American exceptionalism is dead just because of US equities underperforming for 12 months. But at the same time, we do need to be vigilant. And part of the US edge absolutely does rest on strong institutions. And we really should scrutinize any potential change to those institutions. And we should also stay focused on other parts of the world as well, which are starting to become more exceptional than they have been historically. So that's really the setup for American exceptionalism, Jen.
I think it will help if you help us to understand what is under threat currently in terms of this narrative of exceptionalism for the US.
I mean, it's the right question, I think, Jen, although I would also say that threat is, I mean, that's quite a strong word, isn't it? But American exceptionalism is definitely evolving. And I'd highlight three key areas where I think we need to be really vigilant. Part of the formula for American exceptionalism has been strong, independent institutions. So the rule of law, the Federal Reserve, shareholder protections. And these are important because they give companies the confidence to make long term strategic decisions. And they also allow investors to make allocations with confidence. And there is the possibility that over time, political polarization in the US, pressure on institutional independence, Fed independence, for example, and also unpredictable policy, these could just gradually erode the trust premium that investors have historically assigned to US assets. That's area number one where we need to be vigilant. But even there, Jen, I'd say there's no certainty that this trust is going to be undermined. I mean, recent developments in the US are most definitely challenging for investors because they're change. They're not what we're used to. If you look back over the period since the Second World War, there are plenty of precedents of institutions in the US just being tuned. And it hasn't always stopped the US from thriving. In fact, far from it. And I'd also remember that any changes in investor perception on these institutions is going to be gradual. Now, the second area where we're being very vigilant is this area of debt sustainability and shifting global capital flows. We've all been very focused on how the US, the fiscal deficit and also the current account deficit in the US, they've been persistently large. They both rely on continued foreign appetite for dollar denominated assets. So essentially, they require foreigners to invest in the US. And our work on the great global restructuring really shows how trade rebalancing and geopolitics could actually lead to some repatriation of foreign capital currently in the US and then basically sending it back home. And so this obviously raises questions around kind of long-term debt sustainability. But once again, we're right to be really vigilant on this. But I also remind that the US is actually it's in a very strong position with the dollar actually continuing to be the world's only reserve currency. And that's a role that is really hard coded into the global financial system. It can only change very slowly. It can't change just because investors are becoming a little bit negative for a short period of time. And then the final thing I'd say, Jen, is just remember that part of the formula for American exceptionalism is being corporate governance. And this is an area where other parts of the world, especially Asia in particular, they're actually starting to catch up. So US dominance in terms of having the world's best corporate governance, that's no longer unchallenged. And so I'd call out Japan, Korea, and China as being countries where there's clear evidence that improving corporate governance actually is starting to lead to better outcomes for investors. So I think those are the three that I'd really lay out. Those are the areas where we need to be vigilant, Jen.
So now I want to bring the conversation round to AI and big tech. Inevitably, those topics come up when we talk about US. But where do you stand on this debate of whether there is a bubble there?
Yes. Well, I think the first thing I'd say, it's exactly the right question, Jen. And artificial intelligence is this amazing transformative new technology. And fortunately, we have some historical precedents here, which is we've seen how markets behave when we get these new technologies. And they generally go through a very distinct pathway where it's two phases. So phase number one is the phase where you essentially install the infrastructure that enables the new technology. So think of rails for railroads, think of fiber for the internet. And then phase two is the phase where companies figure out how to use the new technology. So think of kind of smartphones, kind of ride sharing, social media, and so on. Now, there is an uncomfortable reality that historically, the first phase, the infrastructure phase, it's always ended in a bubble and then a financial market crash. And so the question is it going to happen this time? And the answer is maybe, but not yet. Start by thinking about valuations. So the valuations of a lot of the AI infrastructure companies, so semiconductor companies, for example, the hyperscalers, they do appear quite high. But when you factor in future revenue growth, future profit growth, then actually those valuations seem much more reasonable. So, for example, if you're looking at future earnings growth, Nvidia has a price earnings multiple of 30 times, TSMC, Meta 20 times, SK Hynix, that's actually valued at only 7 to 8 times earnings at the moment. And just to be clear, I'm not kind of recommending these stocks in any way, but I am saying that if you factor in future growth, valuations don't seem so high. So the question then you have to ask is the growth going to come through? And you have to first think about, well, who's doing the shopping? Who's actually doing the purchasing, driving that growth? And it's the big hyperscaler companies. And they certainly have the profits and the cash flows to pay for the growth. And in fact, they're some of the most profitable and cash generative companies of all time. In addition, what they're also telling us is that their AI infrastructure, it's already been used at about 95% utilization. So they have almost no spare capacity. They need more capacity. They need to grow. And it's very, very different from the situation in the dot-com bust, where in 2002, all that fiber that had been installed to drive the internet, it was only 3% utilized. So very, very different from today. But of course, there are also estimates out there that the total spending on AI infrastructure will have reached around $7 or $8 trillion by the middle of the next decade. And I think we have to ask, can that scale of investment ever have an attractive return? Well, the way we think about it is that if you assume the business opportunity here for AI is basically to take meaningful market share of the global knowledge worker economy, that today is a $40 trillion economy. And so the idea of making a $7 trillion investment to take share from a $40 trillion marketplace, well, actually, there is a case for this scale of investment, but it does depend on companies finding productive ways to deploy AI to improve their performance and their productivity. And that's got to happen quite soon. It's got to happen over the next couple of years. And I think at this stage, the jury is out on whether or not companies can use AI productively. But we're optimistic. And that's because we're meeting with a lot of companies, so banks, industrials, retailers, especially pharmaceutical companies, some of the software companies, where they have really hard evidence that AI is impacting their bottom line already. And so quite a long answer there, Jen, but really setting the scene for the fact that maybe one day AI will be a bubble, but not yet.
Still to come. Shareholders are waking up to the benefits of stronger corporate governance in some Asian markets. Which markets are these, and how can you ride this trend?
Lens on Singapore is now bigger and better. The same deep dive exploration of socioeconomic and geopolitical issues which impact our lives here in Singapore and the region is now a video podcast. If watching a conversation is your thing, join Clarissa Montero in monthly conversations about things that matter. Subscribe to the BT Lens On playlist in the podcast tab of the Business Times YouTube channel and start watching today. BT Lens On Singapore, now available in audio and video.
And now, back to Wealth BT, a podcast of BT correspondents.
Welcome back. Andy, let's talk a bit about AI in China. China has its own AI sector that it wants to develop. Right now, because of geopolitics, we see these two superpowers in opposition. So what's the scope for developments in China and the US to actually complement each other?
I mean, for investors, I think they already do complement one another. But if I just start by taking a step back, Jen, our view is that, at this stage, it looks like there are going to be two big early winners in AI, and it is going to be the US and China. That's because these are the two countries with the resources and the capabilities to do massive build out in the compute power that's required to drive artificial intelligence. But I do think that the pathways are likely to be different. And it's partly because of different access levels to the fastest semiconductors, which really enable AI. But it's also because the two countries and the economic cultures are very, very different. The US has a very particular way of driving a new technology through the economy. And it's basically because of the way that corporate management in the US, well, they're prepared to move fast and break things along the way. That's how US companies operate. And it's obviously worked very well for the US. China has a very different model. It's one that's also been remarkably effective, and it's one that's driven much more by top-down government initiatives. So governments setting clear direction for what they require companies and actually individuals to do with how they embrace new technologies. And both of these approaches have been very successful, but they're just going to lead to success through slightly different ways. And undoubtedly, geopolitics does frame the relationship between the US and China as competitive, and they're most definitely rivalries. But at the same time, both systems are advancing artificial intelligence kind of in parallel, often addressing different use cases, different domestic priorities as well. And from an investment perspective, I mean, the global artificial intelligence ecosystem, it doesn't need a single winner. And actually, we like the idea of different pathways to success and having different ways of diffusing the new technology through the economy. So what matters most for us from an investment standpoint is basically which companies are going to be able to deploy AI productively and profitably. And I think we could see that happening quite well in both countries.
So I'm going to take the conversation back to corporate governance in Asia in particular. Do you see these developments becoming entrenched, and what benefits are already coming out from this?
Thank you for bringing this up, Jen. I always worry a little bit whenever we talk about corporate governance because it's quite a dry term and people tend to check out a little bit from the conversation. So please don't check out. This is a really, really important investment trend. And as a reminder, corporate governance has been a really important part of American exceptionalism, but Asia is catching up. And I think it's partly why is it happening, but then also what has actually happened. The why it's happening is because for slightly different reasons, Asian countries are recognizing that it is of existential importance that they revitalize their economies and their stock markets. And so the best case study so far is probably Japan, which really starts with Abenomics 12 to 15 years ago. And that's really a recognition in Japan that they needed to revitalize their economy so that they could continue to be competitive against China. And so Abenomics starts to sharpen the focus on corporate governance. Then it's continued over the last 3 or 4 years with a number of regulatory pushes to companies to basically raise their valuation. And it's worked. So we've seen much higher dividends. We've seen much more stock buybacks. We've seen a meaningful re-rating of equity markets. So valuations have gone up. But for me, Jen, the most exciting measure is actually earnings per share growth. And if you look over the last 10 years, earnings per share growth in Japan has actually been even higher than the US. And so that really shows what happens when you have a real push to actually sharpen corporate governance. And we've seen something very similar that's been starting in Korea. They have a program which they call the Value Up program. It's kind of 1 to 2 years old now. And again, the empirical data on this is really, really exciting because last year, Kospi, the Korean equity market, that was pretty strong. But actually, the Value Up index, so this is the index of companies that are complying with the corporate Value Up program, it actually outperformed by 8%. And so this is a pretty exciting development. And then the latest development, which we're watching very, very closely, is what's happening in China, where the Chinese Securities Regulatory Commission has put in place something called the Market Value Management Program, which essentially is exactly the same idea. It's improving corporate governance. And we suspect that it will be successful because China, again, has a really critical strategic imperative, which is to continue to raise foreign capital to enable its economic objectives. And it is much better to do that at higher equity valuations than lower. And so, again, a very important initiative that has the potential to really drive improved corporate governance and hence improve shareholder returns. Now, I don't know whether or not these Asian countries are necessarily going to eliminate the gap with the US, but they're going to narrow it. And this has the potential to be very rewarding for investors.
That's interesting because institutions have always placed or demanded a higher risk premium from investing in Asia and the emerging markets. Do you see that this is changing? I mean, you speak to a lot of institutional investors. How are they maybe their stance towards Asia, is that changing?
Well, yes, the smartest investors in the room are spending a lot of time thinking about Asia at the moment. And I think this is for a few different reasons, Jen, actually. undoubtedly, one of those reasons is this improved corporate governance idea. And ultimately, we, on behalf of our clients, we like to invest in companies where the managements are really focused on trying to generate good shareholder value for our clients. And so improved corporate governance is a big focus for big institutional investors in the region. A couple of other ideas I'd put out there. We're seeing with this very new era of geopolitics and trade negotiations, we're definitely seeing a number of Asian countries realizing that they need to restructure how they run their economies and potentially start to invest in some form of reindustrialization. And that has the potential to generate really quite strong returns and investment opportunities.
On that note, thank you, Andy, for joining us and for your insights.
Thank you, Jen.
We're recording this in early February, and markets have been very rocky wherever you look. Precious metals, U.S. stocks, Asia and emerging markets too. But volatility isn't a bad thing, even if it may be worrying. Volatility will shake the narrative around themes like the U.S., big tech, and the dollar. I'm like a broken record, but it pays to keep your cool and stay invested. The long history of markets shows you can't ignore the U.S., but it pays to diversify and always invest in quality. BT Correspondents will be back next week with an episode on transport. Until the next time, I'm Genevieve Cua. Thank you for listening.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.